For decades, corporate strategy was built around a central assumption: the future could be forecast with reasonable confidence. Companies created long-term plans based on a single expected outcome, adjusted those plans annually, and measured success by how closely results matched projections. In 2026, that approach no longer holds. Across corporate America, scenario planning has moved from a niche strategic tool to a core pillar of corporate strategy, driven by the recognition that uncertainty is no longer temporary but structural. Scenario planning is not about predicting the future with precision. It is about preparing for multiple plausible futures at the same time. Instead of betting the business on one outlook, companies explore a range of scenarios and design strategies that remain viable across them. What once felt overly cautious or academic has become essential as volatility, disruption, and rapid change have become constant features of the business environment. The primary force behind this shift is the breakdown of traditional forecasting. Economic conditions, interest rates, consumer behavior, regulatory frameworks, and geopolitical dynamics now change faster than planning cycles can keep up with. A forecast that looks solid at the start of the year can become outdated within months. Leaders have learned that relying on a single projected outcome creates false confidence and leaves organizations exposed when reality diverges. Recent experience has reinforced this lesson repeatedly. Supply chains failed without warning, demand patterns shifted abruptly, financing costs changed faster than expected, regulatory pressures emerged mid-cycle. Companies that planned for one future were forced into reactive decision-making. Those that had already explored alternative scenarios responded more quickly and with less disruption. That contrast has reshaped how strategy is approached at the highest levels. Capital allocation decisions have been especially influenced by the rise of scenario planning. Investments in expansion, acquisitions, hiring, and infrastructure now carry higher risk. A project that performs well in a strong growth scenario may perform poorly or fail entirely under slower growth or tighter financial conditions. Scenario planning allows leaders to evaluate how investments behave across different environments before committing capital. The question shifts from whether an initiative works to when it works and under what conditions it breaks. Interest rates have amplified this need. When capital was cheap, strategic mistakes were easier to recover from. Today, financing costs magnify errors. Scenario planning helps companies understand how strategies perform under different cost of capital assumptions. It exposes fragility early and encourages more disciplined, phased investment rather than large, irreversible commitments. Risk management has evolved alongside this shift. Traditional risk frameworks often focused on individual risks in isolation. Scenario planning examines how risks interact. A supply disruption combined with regulatory change and demand softness produces very different outcomes than any one factor alone. Corporate strategy now accounts for compound risks, not just standalone threats. This leads to more resilient decision-making and fewer surprises. Investor expectations have also pushed scenario planning into the spotlight. Shareholders are less forgiving of unexpected performance swings and sudden strategy changes. They expect leadership teams to demonstrate preparedness, not just optimism. Scenario planning strengthens credibility by showing that management has considered downside risks and built strategies accordingly. It supports clearer communication around uncertainty rather than reliance on overly confident projections. Scenario planning has changed how boards engage with strategy as well. Instead of approving a single strategic plan, boards increasingly ask management to present multiple scenarios and explain how decisions hold up across them. Directors want to understand which assumptions matter most, which decisions are reversible, and which create long-term exposure. This deepens strategic discussion and improves governance. Operational planning has been reshaped by the same logic. Workforce strategy, supply chain design, and pricing decisions are now evaluated across scenarios. Leaders want to know how quickly costs can be adjusted, how resilient operations are under stress, and how customers might behave under different conditions. Scenario planning reveals operational weak points before they become crises. Technology and AI investment have further increased the importance of scenario planning. These investments are often expensive, long-term, and difficult to reverse. Adoption rates, regulatory responses, and competitive dynamics are uncertain. Scenario planning helps companies avoid overcommitting to optimistic assumptions and encourages staged deployment tied to learning and performance milestones. Regulatory uncertainty is another major driver. Rules around data privacy, AI accountability, labor, and environmental standards are evolving rapidly. Scenario planning allows companies to explore how different regulatory paths affect costs, growth, and compliance. This reduces the risk of strategies that only succeed under narrow regulatory conditions. Scenario planning has also improved decision speed rather than slowing it down. When uncertainty hits, companies that have already explored scenarios can act decisively. They are not debating fundamentals under pressure. They are executing responses that have already been considered. Preparation replaces panic, allowing faster and more confident action. This shift has changed internal culture as well. Strategy discussions are less about defending forecasts and more about understanding trade-offs. Teams are encouraged to surface uncertainty rather than suppress it. Scenario thinking spreads beyond finance and strategy teams into operations, product, and leadership. This shared awareness improves alignment across the organization. Importantly, scenario planning does not eliminate risk or guarantee success. Its value lies in reducing surprise and limiting downside damage. Companies still make bets, but those bets are informed by a clearer understanding of potential outcomes. Scenario planning helps leaders avoid strategies that depend on everything going right. The growing importance of scenario planning also reflects a broader maturity in corporate strategy. Businesses are no longer assuming stability as the default state. They are designing strategies for adaptability rather than optimization. Success is defined by the ability to navigate change without constant reinvention. In 2026, scenario planning has become a strategic necessity because the cost of being unprepared is too high. Volatility is no longer rare, and confidence based on narrow assumptions is fragile. Companies that integrate scenario planning into their core strategy are better equipped to allocate capital wisely, manage risk proactively, and communicate credibly with stakeholders. The growing importance of scenario planning in corporate strategy ultimately comes down to one reality. The future will not unfold in a straight line. Businesses that accept this and prepare accordingly are not predicting the future. They are building the capacity to survive and succeed no matter how it unfolds.